Hey traders, this is Blake Morrow with Traders Summit, and with me for the very first time, I have Mr. Tommy Lackey. He's a portfolio manager at Relativity Capital Advisors. Good to see you, Tommy, and nice to meet you.
Hey Blake, how are you? It's nice to meet you as well. Thanks for having me.
Oh, it's a pleasure. When we were discussing ahead of this recording, talking about how our paths crossed on stock twits many years ago, we're talking like 10, 12 plus years ago.
I know. It's been a while. And that's, being someone like myself in a small firm, stock twits and Twitter were kind of the way you found other traders at that time.
It really was. And it's in social media, the financial Twitter sphere, if you will, has been really good. It's been a great way of really connecting with a lot of traders. A lot of guys and gals that I've worked with over the last few years really are people I've never even met, but I just meet them on social media. And next thing you know, we're on the other side of the world, but we're still communicating. It's a great thing, isn't it?
It is. And I have a lot of those same relationships. And again, people I've never met, talked with one for the first time just a few months ago. And it was pretty interesting. After 8 or 9 years, I actually talked on the phone.
That is pretty cool. Well, tell us a little bit about yourself, since this is our very first time together. And I do want to see some of the things that you might be looking at, especially with the market. Obviously volatility's picked up. We've seen, stocks come under tremendous selling pressure over the last couple of weeks. Seems like we're consolidating. The Fed's got their hand in the game now. And, we don't know if we have that Fed put. So there's a lot happening, and I know there's a lot technically you're probably looking at, which I'm super excited to hear about. But first, tell us a little bit about what you do and your background.
Okay. My background is I came into the business as a financial planner, got my CFP, did all that, and then went through the 2000 crash. Watched a lot of clients get hurt because I was doing more of the planning, less of the investing, and decided at that point I wasn't going to have it happen again. Most of my clients were people I'd known almost my whole life. So that was a really devastating mental thing for me. So I went through and said, okay, what's my best way to avoid this in the future? And it came out that it was basically technical analysis, trying to use more price, more charts, more quantitative analysis than using the fundamentals or listening to the institutions that supposedly are there to lead us.
It's interesting. You said something, that when we were talking privately that really stood out. You'd mentioned something like during the financial crisis, the outperformers in the market were the ones that were technical analysis based.
Correct. From 2000 to 2000, I think it was 2 or 3. I looked up as many as I could find and find track records to. It was about 200, and there was only about 5 that were positive over that whole time period. And All 5 of them were technically based.
So that provoked you into getting your CMT, which is, I've talked to a lot of CMTs, and it's one of those designations which, thinking back 20 years ago, I should have probably pursued that. But, we have the, heads of the CMT organization on Traders Summit. We have a lot of CMTs, and I think it's a great designation to have.
Yes. Yeah, I love it. And I'm naturally a math guy and also a visual guy. Yeah. So once I found charts, it was just really a nice match.
It was like peanut butter and jelly. Mm-hmm. Awesome. Well, Tommy, tell us a little bit about how you're seeing this market right now and how you're viewing this current environment, because, you know as well as I do, I started trading in the mid 90s, probably back when you were in, looking at everybody's portfolios. We've seen the crashes. And we've really enjoyed 13 years of this relentless, minus a month and a half, or month, 3-week decline that we really saw. And we've had 13 years of really this massive move in markets. And here we are kind of consolidating things of volatility. So what's on your radar? And you're more than welcome to show your screen at this point. But is there anything that you're really looking at right now?
Well, before I do that, I want to make one comment there as far as the 13 years and all that. That's where I see things a little differently because the way I break things down. I think definitely when you look at the major weighted indexes, that has been the view of it. But I think we've had a couple of really good 13, 14 area, 17, 18 area to where you saw the majority of the market actually underperform or pull back, and even some would say a bear market if you took kind of a geometric average or something like that versus these indexes that everybody's focused on. And the institutions love to basically say that these markets have been in a straight up fashion. So I'm really not sure they have. But at the same time, I think that's what we have to do as traders is figure out where to go in the market.
Yeah.
And it's one of those scenarios to where while I'm not at all against pulling out, having the higher cash levels, our situation is that whereas I don't use extremely high cash levels a lot, I have no parameters in our portfolio. So I could go to 80% cash if I wanted to, even a diversified portfolio if I didn't like. And in 2007 and 8, we were very heavy. We were up to almost 60, 70% cash sometimes, and sometimes even short in that. However, I think right now we're in a situation where we're in a little bit of a no man's land. I think we've gone into a situation where we've gone back to one of those times where the overall markets have been correcting since early last year. And the majority of stocks have been correcting since then. It just hadn't hit the indexes until recently. And a lot of times when we see these types of moves, that is towards the end of the move. And if you look back over your charts or you study your S&P or Dow for a decade or two, you'll start to see those positionings to where the Russell came way down, some of your mid caps came way down, but your S&P was only down 10% on a normal correction. A lot of people just ignore those. And I think we have to realize that a lot of times, and sometimes I call it a stealth bear market, that we have those underneath the surface when nobody's watching.
Interesting. Well, okay. So tell us how you break down your technicals. And like I said, what are you looking at, but how do you break it all down?
Okay. We break it all down, and we're going to go towards this at the end, but I'm going to move over to basically our website that we built to go through my process. I used to do this on 6 different programs through Excel, through Metastock, through eSignal, all these things. And I finally this last year had it all built into one website. And what it basically is it focuses itself on 4 pillars of relative strength. From a momentum standpoint, the only thing I really use is RSI, which we'll get back to in just a second. From a participation standpoint, which is a type of relative strength, I use all the different breadth measures. I use relative comparatives as kind of a confirmation of whether we're outperforming or underperforming the benchmarks we're following. And then I use a relative strength calculations to then quantify which actual areas we want to focus on. Now, the screen you're looking at right here is the macro page, which is always a free page on this site. But I post a lot on social media, these triple play charts, which is the SPY, the QQQ, and the IWM. Okay. These to me are the 3 to sit next to each other and always follow because they can give you an idea of what different areas of the market and how they're moving on a very surface level. But in order to, how do I break down the market? Well, what we've done is we've taken over almost 3,000 stocks and we broke them down into our own equal weight index. Once we break the equal weight index, we also break it down into 11 equal weight sectors. And then we break those 11 equal weight sectors down into 51 equal weight subsectors. And so basically what we do and what we're seeing right now, I'm going to flip over to a different page real quick. This is the universe that we use, which is all 3,000 roughly. And these are our equal weights charts with RSI in this kind of scenario. I studied for a while with Andrew Cardwell, working on RSI for about 10 years on basically how to use it more as a trend following indicator as opposed to overbought, oversold. It's a huge, really good trend following indicator. It's a terrible overbought, oversold indicator. And so it's one of those areas where as much as I love RSI, so many people use it wrong the majority of the time. But in this, I look at the markets as a whole as right now, like I said, kind of in a no man's land, more so because of the breadth than because of the actual price action and where it's going so far. Our breadth a couple of weeks ago, as we can see right here, if you can see where my cursor is.
Yeah, I see that.
This one right here is the breadth thrust indicator. McClellan oscillators right above it, McClellan summations above that. And then I have the 3 major moving averages, advanced decline line, and then the new high, new low indicator from Manus with the 2 things. So this is all the way from your longest term breadth all the way down to your shortest term with breadth thrust in one view to see kind of where things are going. Well, when we get a breadth thrust down here between 30 and 40, and then we get a divergence, that oftentimes is a very good bottoming signal. Sure, any bottoming signal can get broken, but that's a pretty powerful signal that can play out. So that's why right now I think we're kind of in no man's land because we got the strong bounce out of the bottom. But right now my feeling is we got so washed out in so many sectors and subsectors, I'm not sure we're done. I'm gonna flip over to one other thing real quick here, which is what we call our quick views. These will be available to subscribers of the site, but we have to do them on here because of the data we're looking at. I'm sorry. Yeah, okay, there we go. This view right here gives us every one of the sectors, subsectors, gives us the percent making 10-day highs, percent making 10-day lows, percent above the 20-day moving average, and breadth thrust. These are your best short-term indicators from a breadth standpoint. About a week ago, this whole thing was almost all red. Not pink, I mean red. And those are my zones that are so washed out that we just can't go much further. And as I tell everybody, you can always go further. The thing we have to realize about markets is markets that once they get stretched to a certain point as a whole, not an individual security, but a market as a whole gets very reflexive. Yeah. Where once you get it past a certain point of stretch, it's going to erase that whole stretch when it does bounce, even if you're in a bear market. So you get to these points of washout that we know at least a short-term bounce is coming real soon. And then in that bounce is where we get most of our information on where buyers and sellers really are. We get more information out of the bounce than we do out of the actual initial drop.
All right. So, when you're talking that it's like sentiment or anything else. Once it gets overstretched, you're going to revert back to the mean. But as you're seeing that shift occur, it's what's beneath the surface that's giving you the opportunities, if you will.
Correct.
That makes a lot of sense.
So we shift over there to, and what you'll see on the side is that on this particular site, every page is the same. Whether you're looking at a sector, a subsector, or the universe, it has all the same charts on it. So that when you flip from one to the other, you have a really good flow of what you're looking at. And so like here's our technology sector that we broke down. You can see it's in an RSI bear range. Sorry, it's down here below our MA bands and it's below the range here. So this is a tough spot to be in. But with the bottoming nature we found, unless we break back down below probably this week's lows, and then we're looking at probably a zigzag scenario to go up, and then we test and see kind of where we are. Now, again, these can be nullified. All this is just probability based. It's not. But when we pull down here, again, I have all these same breadth numbers on here. And again, last week we got to where basically we only had 3% of all of the technology stocks above their 20-day moving average. We only had about 7% or 5% above the 50-day. That doesn't happen very often, Blake. That only happens either in the start of a really, really bad bear market, or it happens at the end of a correction.
So that would coming back to your comment. I'm not really too sure if we're done yet. That going back to your previous comment.
Sure, you can't be at this point.
Yeah,
you really can't be. And if anybody thinks that they can be sure this was a longer term bottom, we're wrong. I mean, we can't be. There's no way to until we see in this bounce how buyers show up. Those first few days, they were very strong and gotten kind of kicked the last couple of days. And we'll have to see. Now is the time we see where we can catch it. One of the things I talk about a lot with clients, and then we did like in March 2000, all that is when we enter something new, we don't enter it with a hard target. We look for milestones instead of targets. So if we enter something, the congestion that a lot of people call a hard target, we're going to kind of watch how it acts at that congestion and then have our actions based on that. That way it can keep you in longer if it actually was the bottom. But if not, you're going to have a small consolidation and then it's going to break back down and then you can exit. But it's one of those scenarios to where a lot of people like to wait until they've proven and have that consolidation break back higher. I think you can get some really fast moves. And as long as you have a little bit of time span behind them, when you're talking about sectors and larger, not an individual stock, because any individual stock can drop as far as it wants. But, you're not going to get the technology sector, the utility sector, the whole sector going past a certain kind of a stretch. You'll get some money coming in there because the institutions want to find value. Yeah, that makes a lot of sense. Well, Tommy, I'll tell you what, I'm really excited about having more frequent conversations with you, getting a good idea of what the markets are doing, especially your breadth indicators, RSI. But let me ask you this. I've used relative strength over the years. That's like predominantly the only indicator I use. And I've told traders that I've been with for the last 20 some odd years, what you see is basically a tool. It's how you use the tool that really will make you the money. It's, you and I can have a hammer and use a hammer one way, I use a hammer the other way. We might have different results. But when you're looking at things in your site and you're looking at these divergences and putting it all together, it does make sense to me. And so what do you think right now is maybe the best
opportunities for us?
I mean, again, depends on if you're a nimble trader or if you're more of a position-based trader. If you're a nimble trader, I think you do have to start looking at the stuff that's gotten kicked to the curb so hard. I think you have to look for good, solid entries and some software names that are good, strong names. You know, one that's been good recently is Datadog, DDOG, NET. A couple of those names have started to come off their bottoms and show a little bit more both life, volume, and but again, I can go into two different things. Number one, is you're looking at right here is I talked about the relative strength I do these based on the list that's there. And so like this is just all the technology ETFs. So I can sit here and sort this, search this, see on all these different factors. I like what's called the RS movers, which is anything that's moved more than X number of points over the last 5 days. You can kind of see each day who's moved the most from a relative strength standpoint here, or just look for the strength. You're right. It's how you use it, because if you're in the strongest sector like energy right now, you don't want to be buying the hundreds because they've already moved a long way.
Right.
But if you're looking in consumer discretionary that's got its rear kicked for the last 2 months, then you're looking at things that are moving up into the 80s and 90s now, while it's just starting to put some stakes in the ground and flatten out.
You know what? I love it, Tommy. You're like, you know, you got to be weaving when people are bobbing, right? It's what traders do.
Exactly. You got to be able to find those things, and you got to have the mechanism to find those things in here. See, that was the ETFs now down here, and this is on every page, every sector, every subsector. This is every single technology stock ranked just against the technology stocks. So again, any given time I can pop in here. I'm going to flip over here to the actual software page. There's 165 software names. How would you know which one to go to without some kind of a mechanism? And again, we have all 165 in here ranked against each other every day, and we can sort it by the daily gainers, the weekly gainers, the RS, and then the RS movers, which I love. Now, if you're in a strong sector like like energy, you look at the RS movers and you look for things in the 50s and 60s, because that means they're the things that moved the strongest over the last 5 days, but they're just really in the middle of the pack still. In technology that's gotten kind of killed, we can look at the RS movers and things that have moved more. You know, one example here that moved up, we'll just use SPC. And, you know, I don't even know this stock right here, but we'll take a look at it. It's moved up 20 RS points in the last 5 days. And so it gives us the opportunity to hop in here, link over to TradingView. I'm a member of TradingView, so this is my actual own template, but it links over, it'll pull up the chart for you. And then you can take a quick look at, okay, is this one that is a decision maker for me or not? Again, the chart is the ultimate arbiter. All the rest of this gets us to the chart as fast as we can. And again, the entire site is set up to basically allow you to find strength and weakness inside the market in a quick flow from top down. And you can do it all in charts. You can get the economic background in charts, you can get the overall market view, and you can get all the way down to the individual security level. Again, as we look at this one, this is probably not one of the ones that's right on my radar until we get over this probably 127 area. Nice little consolidation, might be your right shoulder, but again, still has some proving to do in my world to see where we are. But that's one of the things we love about the size. It gives us that opportunity. I use it for what we do. We have 2 different types of portfolios. We do stock portfolios, but we mainly, our core clients are in what we call a core and explore, which is a diversified portfolio that has anywhere from 20 to 40% in a sector rotation model for the alpha side of the portfolio. So having the ETFs in here, having this view on what themes and what areas are working or aren't is pivotal to what we do.
Well, you know, Tommy, I'll tell you what, I almost like what you're doing here better than what I read on IBD. So tell me this, if I'm a trader, I'm at home and I'm like, man, I like what Tommy's doing. How do I follow you and figure out exactly what you're doing and follow your work a little bit closer?
Okay, sure. Well, you can follow me at GT Lackey on pretty much every social media. It's just GT Lackey.
Okay.
The Power Investing is at Power, POWER, the number 1 INVESTING. So Power Investing, but a 1 instead of the I.
Awesome.
And that's how you can do that. And then, of course, you can click through to the website and all that. For the next couple of weeks, powerinvesting.com is going to be free for everyone. All pages, all the data. We put out a weekly macro video in the beginning of the week, a sector video at the beginning of the week. And then we'll just randomly be putting out different types of data and information based on what we're seeing. When we see big washouts, we try to make sure we post those that information as well. because we really think that, you know, identifying the turns is important, whether you get on board right away or not, but you got to know when it happens.
Right. Well, that's awesome. And well, Tommy, I'm excited about that. And what people can do now is, if you're watching on YouTube, go to the link in the description of this video. It'll take you there. It'll take you to where Tommy's at. Also, if you're watching us on Trader Summit, we also have a link that takes you back to his site right here in his profile. So Tommy, thanks for spending time with me today and the rest of us. And I'll tell you what, I'd love to meet up with you here in the next few weeks and see what's on your radar and what breadth and RSI is telling us about the markets, because I'm sure we're going to get more volatility in 2022.
Oh yeah, I believe you're right. And I would love to, basically, you know, especially anytime you feel like things are getting washed out, come see me.
All right. Or you can come see me. All right, Tommy, thank you so much for spending your time with me, and we'll talk to you soon.
Thank you, Blake. Have a great afternoon.
You too. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.